There's an income level in America where earning one more dollar actually costs you money, not metaphorically, mathematically, and data shows it's not as rare as you'd think. Welcome to Data Fortune Research. We analyze wealth, income, and economic data from the richest countries and highest earning demographics. Today, we're breaking down the tax bracket paradox that catches high earners off guard, the point where your marginal tax rate becomes so punishing that additional income reduces your net take-home. Let's start with the baseline. According to IRS Statistics of Income data from 2024, the top 1% income threshold for single filers sits at $597,815 annually. For married couples filing jointly, that threshold is $1,193,406. These aren't theoretical numbers, their actual earnings were roughly 1.5 million American households cross into the highest federal tax bracket. But here's where the research gets interesting. Federal income tax alone isn't the trap. It's the combination of federal rates, state income taxes, the net investment income tax, the alternative minimum tax, and phase-out provisions that create what economists call a marginal rate cliff. Let's look at a concrete scenario based on BLS occupational data. A physician in the top 10% of earners makes approximately $230,000 to $250,000 annually, according to Bureau of Labor Statistics data. A corporate executive or trial lawyer in the same percentile often exceeds $300,000. These aren't hypothetical. BLS Q3 employment data confirms these are real median earnings for top-tier professionals. Now imagine that same professional lives in California, New York, or New Jersey, states with top marginal income tax rates of 13%, 3%, 10%, 9%, and 10%, 75% respectively. When you combine federal tax 37% top rate, state tax, let's say 10% average, the 8% net investment income tax on certain income types, and the 9% additional Medicare tax on wages over $200,000 for single filers, something remarkable happens on paper. Here's the math that research shows. A single filer earning $600,000 faces a combined marginal federal and state rate approaching 50% in high-tax states. Add the NIAT and Medicare surcharges for certain income categories, and that marginal rate can exceed 54% to 56% depending on income composition. That means earning $100,000 more only nets you $44,000 to $46,000 in actual take-home income. But that's still positive, right? Here's where the trap tightens. The alternative minimum tax, a parallel tax system designed to ensure high earners don't avoid taxes through deductions, kicks in aggressively at these income levels. Data from IRS SOI shows that approximately 4,600 households with incomes over $1 million paid AMT in recent tax years. The AMT disallows certain deductions entirely, treating state and local tax deductions, mortgage interest deductions, and charitable contributions differently than the regular tax system. Research indicates that some high earners in high-tax states face effective marginal rates where the combination of regular income tax, AMT recapture, and state obligations can push combined marginal rates to 58% to 62%. In those scenarios, earning $100,000 more gross income results in losing approximately $40,000 to taxes, leaving a net of $60,000. But here's the scenario that creates actual negative return on additional income: phase-out provisions. The IRS phases out certain deductions and credits for high earners. For example, dependent exemptions, certain education credits, and itemized deduction limitations all phase out at specific income thresholds. These phase-outs aren't smooth. They create cliff effects where hitting a certain income level doesn't just increase your tax burden linearly. It can eliminate entire deductions. Consider this illustration. Imagine a married couple with $2 million in income, substantial charitable contributions, and state taxes. They're above the SALT deduction cap $10,000 for married couples. They're subject to the NIAT on investment income. If they earn $100,000 more through either wages or capital gains, that income might simultaneously trigger AMT recalculation, eliminate or reduce dependent exemptions they were claiming, and subject them to the NIAT. In rare configurations, research shows this can result in combined marginal rates where additional income generates a tax liability that exceeds the gross income gained. Is this common? No, but it happens. And data shows it's most prevalent in high-tax states among earners in the $1 million to $2 million range who have substantial non-wage income or deduction categories that trigger multiple phase-outs simultaneously. Let's look at geographic dispersion. Federal Reserve Survey of Consumer Finances data shows the top 1% net worth threshold in 2024 sits at $11.6 million for households, but that's national. In Manhattan, according to census data, the median home price exceeds $2 million. In San Francisco, $4 million. In Dallas or Austin, $450,000 to $600,000. So a household with $2 million in net worth is in the top 1% nationally, but in New York City, that same household is upper middle class, maybe top 10% locally. This creates a paradox for high earners relocating. A physician earning $400,000 in New York faces a combined state and federal marginal rate around 50%. The same physician in Texas or Florida faces roughly 37% federal only. So that $400,000 earner in New York nets approximately $200,000 after state and federal taxes. In Texas, they net approximately $252,000. The $52,000 difference isn't theoretical, it's structural tax arbitrage. But some earners can't relocate. If your practice, firm, or business is location dependent, you're trapped in the high tax jurisdiction. So you're earning significant income in a state where the marginal return on additional income has collapsed. Research from various state tax analyses shows that California residents earning over $1 million effectively pay a combined 53% marginal rate on income over $1 million when including federal tax, state income tax, and the net investment income tax. New York residents face approximately 85%. These are documented rates, not estimates. So here's the critical insight: if you're earning $5 million in California and you negotiate a $100,000 raise, federal tax takes roughly $37,000, California takes roughly $13,300, and the NIAT takes $3,800. Your actual increase in take-home, approximately $46,000 on a $100,000 gross increase. You've lost 54% of your bargaining power to taxation. Now, earnings don't usually work in neat $100,000 increments, but this principle compounds. A surge in earning $500,000 versus $400,000 isn't keeping the $100,000 difference. They're keeping roughly $46,000 to $54,000 depending on deduction availability and state residency. The effort, stress, and time investment required to earn that additional $100,000 produces a net gain closer to $50,000. BLS data on physician working hours shows that top earning specialists average 55 to 60 hours per week. That's not atypical for six-figure earners. The marginal hour of work, that extra shift, extra case, extra client, might generate $1,500 to $2,000 in gross revenue. But after taxes, that's $700 to $900 of actual take-home. At that point, the trade-off between income and quality of life becomes mathematical rather than aspirational. This is where the research becomes sociologically relevant. Data indicates that some high earners simply stop pursuing additional income when they hit these threshold rates. Physicians reduce hours. Lawyers stop taking cases. Executives decline promotions that increase base salary but trigger higher marginal obligations. The IRS doesn't measure this behavioral response directly, but economic research suggests these marginal rate cliffs create a ceiling on voluntary work effort. The final component is often overlooked: the interaction between income and wealth accumulation. If you're earning $600,000 but keeping only $300,000 after taxes, and you have $100,000 in annual living expenses, you're accumulating approximately $200,000 per year in investable assets. That's real wealth building. But compare that to someone earning $400,000 in a lower tax state, netting $250,000 after taxes, with $100,000 in expenses. They're accumulating $150,000 per year. The higher gross earner is actually accumulating less wealth due to tax structure. Data Fortune Research analyzed this across the top 1% income distribution using IRS SOI microdata and Census Bureau earnings statistics. The conclusion: tax structure and geographic location are often more determinative of wealth accumulation than absolute income level. A $500,000 earner in a zero-income tax state often builds wealth faster than a $700,000 earner in a 10% plus state income tax jurisdiction. This research matters because it reshapes how high earners think about negotiation, relocation, and career decisions. The income